Artificial intelligence, once a distant dream of science fiction, is now the invisible force rewriting the rules of the global financial system. It is no longer just a set of algorithms running in the background, it is the architect behind investment strategies, the analyst decoding trillions of data points, and the watchdog scanning millions of transactions for fraud. From Wall Street to the stock markets of Tokyo and London, AI is no longer the future of finance, it is the present. Financial institutions around the globe are racing to harness this intelligence, hoping to get ahead in a game that is rapidly evolving beyond human speed. Algorithms are learning faster than traders, bots are making decisions in microseconds, and machine learning models are adapting to global events before headlines hit the news. This transformation is not just about automation, it is about intelligence that grows, adapts, and optimizes in real time. What we are witnessing is not a mere shift in tools, but a structural revolution that redefines how money flows, how risk is measured, and how wealth is built. Traditionally, finance was a human-led endeavor. Analysts, brokers, and managers spent years perfecting the art of interpreting markets, reading financial statements, and advising clients. But with the advent of AI, that art is becoming more science. Algorithms are now outperforming human experts in identifying investment opportunities, assessing creditworthiness, and managing portfolios. AI does not sleep, does not suffer from emotional bias, and can process volumes of data that would overwhelm any human brain. In this new paradigm, financial intuition is being replaced by data-driven logic. AI systems can analyze historical data, current trends, and predictive models all at once, making decisions that are not just fast, but also shockingly accurate. As a result, roles are shifting. The human financial expert is evolving into a strategist who must understand how to train, monitor, and refine AI systems instead of just making decisions themselves. At the heart of this transformation lies machine learning, AI's most potent weapon in the financial battlefield. Machine learning algorithms are designed to learn from patterns in data, continuously improving their predictions without human intervention. In finance, this capability is game-changing. These systems can forecast market trends, detect anomalies, and model risk with unprecedented precision. Investment firms are using AI to build smarter portfolios that can rebalance automatically based on market behavior. Hedge funds are deploying deep learning models to detect signals that are invisible to traditional analytics. Credit institutions are assessing loan applications not just based on income and credit scores, but through hundreds of behavioral and digital data points. This is a world where learning never stops, and where the smartest system wins. But AI's influence is not limited to the stock market or hedge funds. Retail banking is undergoing its own transformation. Banks are using AI to deliver hyper-personalized customer experiences, automate service queries, and speed up loan processing. Chatbots powered by natural language processing can now handle millions of customer interactions, while back-end AI systems monitor accounts for unusual activity in real time. AI also plays a critical role in fraud detection, where it scans massive transaction volumes for irregularities that even seasoned investigators might miss. For customers, this means faster service, better financial advice, and stronger security. For banks, it means cost savings, efficiency, and a new level of insight into customer behavior. One of the most dramatic shifts driven by AI is happening in the world of trading. High-frequency trading bots, operating on advanced algorithms, can execute thousands of transactions per second, something human traders can only dream of. These bots analyze global news, social sentiment, and economic indicators in real time, adjusting strategies within milliseconds. Major financial firms are now building proprietary AI systems that give them a competitive edge in the market. In many cases, these AI systems are not just following market trends, they are setting them. When billions are moved in a fraction of a second, the trader is no longer a person, it is a machine. And in this new game, speed and intelligence are everything. Beyond speed, AI is changing the very nature of decision-making in finance. In traditional finance, decisions were often made based on a mix of data, experience, and gut feeling. AI replaces that gut feeling with pattern recognition drawn from oceans of historical data. It identifies correlations and causal links that would take humans years to discover. This has profound implications for risk management. Financial institutions now use AI to stress test scenarios, simulate outcomes, and identify vulnerabilities across entire portfolios. What used to take months of analysis can now be done in hours, if not minutes. This allows for more agile decision-making, more proactive risk control, and a sharper understanding of where the market might be heading next. Credit scoring and lending have also been transformed by AI. Traditional credit systems relied on narrow criteria: salary, employment history, and past repayments. But AI systems go further, analyzing behavioral data like online activity, mobile phone usage, and even social media behavior. This means that previously invisible borrowers, those without formal credit histories, can now be assessed more accurately and fairly. In developing countries, AI-driven micro-lending platforms are enabling access to credit for millions who were previously excluded from the financial system. This democratization of finance has huge potential to reduce poverty, increase economic participation, and create new markets. But it also raises ethical questions about data privacy and algorithmic bias. In the realm of cryptocurrency and decentralized finance, DeFi, AI is playing an increasingly dominant role. Crypto markets move with extreme volatility, and AI algorithms are ideal for detecting patterns, anomalies, and arbitrage opportunities in this fast-moving space. AI-driven trading bots are now common in crypto exchanges, and DeFi platforms are using machine learning to assess risks and adjust lending rates in real time. Smart contracts powered by AI can self-correct and evolve based on usage patterns. This fusion of blockchain and artificial intelligence represents the next frontier of financial innovation. It decentralizes trust, automates compliance, and opens up the possibility of fully autonomous financial ecosystems. Central banks and regulators are also turning to AI to keep up with the rapid changes in financial ecosystems. From modeling economic outcomes to monitoring systemic risks, AI helps governments make faster, data-driven policy decisions. Central banks in countries like China, the US, and the UK are experimenting with AI for tasks like inflation modeling, currency monitoring, and financial surveillance. These systems can process millions of data points from multiple economic indicators, offering a more real-time view of national and global economies. AI is also being used to identify shadow banking activities, detect money laundering patterns, and ensure financial compliance across institutions. In this way, AI is becoming not just a market tool, but a regulatory ally. However, with great power comes great responsibility. AI in finance is not without its pitfalls. Bias in training data, lack of transparency in decision-making, and over-reliance on machines can lead to unintended consequences. Financial systems powered by AI can sometimes magnify systemic risks if not properly monitored. There are ethical concerns about privacy, job displacement, and the accountability of algorithmic decisions. Who is to blame when an AI system makes a costly mistake? How do we ensure fairness in models that learn from biased data? These are questions regulators, developers, and financial leaders must confront as they navigate this new landscape. The future of finance may be driven by machines, but its trust must still be earned by humans. In the end, the rise of AI in global finance marks the beginning of a new economic era, one where intelligence is not just artificial, but adaptive, autonomous, and deeply embedded in every transaction, every analysis, and every decision. From Wall Street to fintech startups in Africa, AI is reshaping finance at every level. It is creating opportunities, breaking down barriers, and changing how we think about money itself. The institutions that embrace this change will lead the future. Those that resist may be left behind. Whether you are an investor, a banker, a policymaker, or just someone managing their personal finances, understanding this AI-driven transformation is no longer optional, it is essential. The question is not if AI will change finance, but how far, how fast, and whether we are ready for it. 1. The rise of AI in global finance. Artificial intelligence did not enter finance with a bang. It crept in silently, almost invisibly, starting with data sorting algorithms and predictive analytics. Initially, AI was seen as just another tool to assist with customer support or fraud detection. But under the surface, something much more powerful was taking shape. The vast financial ecosystem, which had traditionally depended on human decision-making, spreadsheets, and siloed departments, began to feel the pulse of machine learning. From Wall Street to Singapore, from the London Stock Exchange to mobile banks in Africa, AI's quiet presence started reshaping workflows. It moved from back-end operations to frontline strategies. Soon, AI was not supporting finance, it was starting to drive it. In the early 2000s, big data became a buzzword. But without AI, data was like an ocean without a map. Financial institutions were flooded with information but had no efficient way to extract meaning from it. Enter machine learning. With its ability to analyze massive datasets in seconds and find patterns undetectable to human analysts, AI began showing its real value. Risk assessment became more nuanced. Credit scoring evolved beyond income and collateral, incorporating behavioral and even psychological data. Insurance underwriting moved beyond demographic groups into dynamic, real-time individual analysis. The entire infrastructure of financial logic began to shift, and that shift favored machines that could learn. Investment banking, often seen as the brain of high finance, was one of the first areas to undergo rapid transformation. AI algorithms began to replace junior analysts, not just by speeding up data analysis but by offering strategic recommendations based on market movements, sentiment analysis, and historical patterns. These systems learned over time, adjusting their models based on results and outcomes, far faster than human teams could adapt. The traditional hierarchy, senior banker mentoring junior associate, started to collapse as algorithms took the place of experience. Decisions were no longer made in meetings but in code. The trader's gut was being replaced by predictive models. AI also introduced a new era of high-frequency trading, or HFT. These lightning-fast, algorithm-driven trades allowed firms to make millions in milliseconds. By analyzing micro-movements in prices and reacting instantly, AI-powered systems began dominating trading floors. Human traders simply could not compete with the speed and scale of algorithmic strategies. Financial markets became more volatile, more precise, and far more dependent on the stability of code. Errors, once made by tired or emotional traders, now occurred when systems misunderstood data or collided with other algorithms. The entire rhythm of the market began to dance to the beat of machines. In the consumer banking space, AI brought personalization and scale together in unprecedented ways. Chatbots replaced call centers. Robo-advisors started managing portfolios. AI-driven budgeting apps began helping users track spending, anticipate bills, and save automatically. For the first time, financial advice became accessible to people who never had access to traditional advisors. AI democratized knowledge, but it also redefined expertise. When an app could outplan a human advisor, the very definition of value in financial services began to shift. Banks that adapted grew exponentially. Those that resisted began to lose relevance. The battle was no longer between big banks and small banks, but between tech-savvy and tech-blind institutions. Emerging markets saw a different but equally powerful revolution. In regions with little banking infrastructure, AI-powered mobile financial services started filling the gap. From digital wallets in Kenya to micro-loan platforms in India, machine learning enabled scalable, low-cost financial inclusion. Credit scoring models used non-traditional data, phone usage, social connections, and payment behaviors. AI did what decades of traditional finance could not. It reached the underserved and unbanked. In doing so, it created new economies and consumer bases that had previously been ignored. For these regions, AI was not just a technological upgrade, it was a foundational leap. But this rise was not without resistance. Traditional finance houses were skeptical. Veteran bankers questioned the reliability of black box algorithms. Regulatory bodies lagged behind, unsure of how to monitor systems that learned and evolved autonomously. Concerns around job loss, data privacy, and market stability started to grow. AI was not just a new tool, it was a disruptor of legacy culture, process, and power structures. Its very presence challenged the expertise of professionals who had built their careers on intuition and experience. The resistance was emotional as much as it was rational. But as results poured in, the tide began to turn. Tech giants saw the opportunity early. Companies like Google, Amazon, and Microsoft began investing heavily in fintech and AI infrastructure. Financial firms, in turn, started partnering with these tech companies to integrate AI capabilities. Cloud computing allowed massive financial datasets to be processed on demand. APIs enabled seamless integration of AI tools. Fintech startups became laboratories of innovation, launching faster, leaner, and more agile services than traditional institutions. The center of gravity in finance shifted from corporate towers to tech campuses. It became clear. The future of finance would be written not just by economists, but by engineers. Academic institutions and think tanks also joined the movement, launching interdisciplinary research into AI and finance. Economists started collaborating with data scientists. New frameworks emerged for understanding market behavior through agent-based modeling and machine learning simulations. Ethical questions, too, gained prominence. If an AI system makes a bad financial decision, who is responsible? How do we audit algorithms? Can AI ever be truly unbiased? These were not just academic puzzles, they were becoming urgent business and policy dilemmas. As AI rose in finance, it forced everyone, leaders, regulators, and users, to ask deeper questions about accountability and control. Ultimately, the rise of AI in global finance is not a single event. It is a living transformation still unfolding. It is reshaping not just how we bank, invest, and insure, but how we define risk, value, and opportunity. It challenges us to think bigger, move faster, and operate more intelligently. But it also asks us to remain human, to question automation, and to build systems that serve society, not just profit. The story of AI in finance is not just about machines replacing humans. It is about rethinking what finance is, and who it is for. And in that rethinking, lies the future of the global economy. As the role of AI deepened in global finance, one major change was the decoupling of human emotion from market behavior. Historically, markets moved not only on economic data but also on fear, greed, and speculation. AI brought in a new player, logic without emotion. Algorithms could buy and sell based purely on trends, arbitrage opportunities, or economic indicators without being swayed by headlines or rumors. This removed a layer of volatility, but also created a new one. When multiple AI systems react to the same event at the same time, flash crashes can occur. Markets have seen moments where billions were wiped out in seconds due to automated misinterpretation. In trying to eliminate human error, we inadvertently introduced machine-induced chaos. Another revolution was the explosion of decentralized finance, or DeFi. Built on blockchain and supercharged by AI, DeFi platforms allowed users to lend, borrow, invest, and earn interest without traditional banks. AI made these platforms smarter, identifying fraud in real time, adjusting interest rates based on liquidity, and optimizing yield farming strategies. This allowed individuals across the globe to participate in finance without geographic or institutional barriers. Smart contracts automated transactions, while AI analyzed market conditions to trigger them optimally. The financial system began moving toward a borderless, permissionless future, powered by algorithms and distributed ledgers. For some, this was liberation. For regulators, it was a nightmare. AI also changed how financial institutions look at talent. Previously, a degree from a prestigious business school opened most doors in finance. Today, firms hire data scientists, coders, and engineers alongside traditional MBAs. The most sought-after employees are those who can build models, write code, and understand machine learning. Human judgment still matters, but it now complements AI instead of replacing it. A new generation of financial professionals has emerged. Hybrids who speak both the language of markets and the language of algorithms. This shift in hiring priorities is also influencing education systems, pushing universities to offer finance programs with strong AI, coding, and data components. Regulation has had to play catch-up at an unprecedented pace. Global financial regulators now face the challenge of understanding systems that continuously learn and adapt. Traditional regulatory models based on fixed rules struggle to keep pace with evolving algorithms. The EU's AI Act and the US SEC's AI-related guidelines are just the beginning of a broader effort to bring oversight to machine-led decision-making. The question of explainability has become central. How do you regulate a system whose internal logic even its creators cannot fully explain? This challenge is driving the development of explainable AI, XAI, a subfield aimed at making algorithmic decisions more transparent. Still, the regulatory landscape remains fragmented and reactive. Looking forward, AI's role in finance is poised to expand further with the integration of generative AI and quantum computing. Generative models are already being tested to draft financial reports, simulate market scenarios, and even propose investment strategies. Meanwhile, quantum AI promises to exponentially accelerate risk analysis, portfolio optimization, and fraud detection. This future holds immense potential, but also unprecedented complexity. The merging of these technologies will redefine what is possible in global finance. The institutions that embrace this change responsibly will lead the next era. Those that lag may disappear entirely. It is no longer just about staying relevant, it is about surviving in an AI-native financial world. 2. AI-powered trading. Beating Wall Street at its own game. Trading used to be an art. Floor traders in suits shouted bids and offers, moved by instinct, rumors, and adrenaline. Deals were made on handshakes and hunches. But that world has changed forever. Today, trading is more science than art, more algorithm than emotion. The rise of artificial intelligence has turned the battlefield digital. Now, machines race against each other in milliseconds, reacting to data streams humans can barely comprehend. Wall Street, once ruled by charisma and connections, now bows to code. In this new arena, AI-powered trading systems do not just participate, they dominate. At the heart of this transformation is algorithmic trading, where pre-programmed instructions execute trades based on defined parameters. These algorithms consider price, volume, timing, and even complex mathematical models to buy or sell assets at optimal points. But AI has taken this further. Unlike static algorithms, AI systems learn. They adapt. They evolve. Using historical data, they recognize patterns that suggest future movements. If a stock typically rises after a certain news pattern or currency pair shifts after specific market behavior, the AI notices and acts. Often, it moves before the market even realizes what is happening. One of the most aggressive forms of AI trading is high-frequency trading, HFT. These are ultra-fast systems that execute thousands of trades per second. HFT firms leverage colocation, physically placing their servers close to stock exchange data centers, to gain microsecond advantages. AI enhances this further by scanning news feeds, social media, and global indicators in real time to detect triggers. If an oil pipeline explodes in Libya, or a tech CEO tweets unexpectedly, the AI bot reacts before a human even reads the headline. In these milliseconds, fortunes are made and lost. The market is no longer slow and rational, it is lightning fast and reactive. Natural language processing, NLP, has also entered the trading game. I can now read, interpret, and act on financial news, earnings reports, and social media sentiment in real time. For example, a sudden spike in negative words in a company's earnings call might trigger an automatic short. A positive tweet from a key influencer could trigger a buy order across thousands of accounts. Human traders used to listen to CNBC for cues. AI reads everything, all the time. It understands nuance, sarcasm, urgency. It quantifies the mood of the market, something humans can only guess. Predictive analytics powered by deep learning is another secret weapon. These systems take in massive historical data, prices, charts, volume, volatility, and try to forecast where assets are likely to move. Unlike traditional indicators that use fixed logic like RSI or MACD, AI learns from each new data point. It identifies seasonality, geopolitical effects, correlations, and nonlinear anomalies. Over time, it builds a probabilistic model of future price action. Traders using these AI tools are no longer reacting to the market, they are anticipating it. They are operating with vision, not just visibility. AI has even changed portfolio management strategies. Traditional models like modern portfolio theory or efficient market hypothesis have limitations in today's chaotic, data-heavy markets. AI can process thousands of factors simultaneously, from currency fluctuations to weather patterns to social unrest, and reallocate assets dynamically. This is the rise of quant funds, hedge funds run not by humans but by algorithms. These funds continuously rebalance based on real-time data. Some funds even use reinforcement learning, where AI tries strategies, learns from results, and refines its actions over time. These models improve themselves with every market tick. A significant evolution is happening in risk management. In the old days, risk was assessed by VAR models and historical volatility. But today's AI systems detect risk in real time. If volatility starts rising in correlated sectors, AI might reduce exposure even before losses occur. If two assets show abnormal inverse behavior, AI raises alerts. It does not just look at financial data, it includes geopolitical headlines, satellite imagery, and even weather forecasts to calculate exposure. This kind of multidimensional risk assessment is reshaping how portfolios are protected. Retail investors have also gained access to AI tools that once belonged only to hedge funds. Apps now offer AI-powered robo-advisors that build and manage investment portfolios for individuals using the same logic as institutional systems. These platforms consider user goals, timelines, risk appetite, and market conditions to auto-adjust portfolios. This means even someone with no financial background can participate in intelligent, dynamic investing. AI is not just beating Wall Street, it is putting its power into the pockets of everyday people. Still, not everything is flawless. One major concern with AI-driven trading is herd behavior. When multiple AI systems identify the same opportunity and act simultaneously, it can cause massive market swings, creating volatility from nothing. We saw this in the 2010 flash crash and smaller incidents since. Moreover, because many AI models are black boxes, it is hard to understand exactly why a system made a trade. This lack of transparency makes regulation and trust difficult. When trades happen faster than thought, who do you blame when things go wrong? Another concern is the arms race among firms to build faster and smarter systems. Billions are being spent on better infrastructure, low-latency networks, and exclusive data feeds. The richest firms with the best engineers dominate the game. This creates a growing inequality in financial markets. While AI tools are democratizing access in some areas, the top layer of AI-powered trading remains highly exclusive, benefiting a few powerful players. The game has changed, but not everyone is playing on equal terms. Cybersecurity has also become a critical issue. With so many trading decisions automated, a malicious hack or error in code could cause a systemic crash. Imagine a rogue algorithm misinterpreting a diplomatic speech as a threat, triggering a massive sell-off across global markets. AI systems must be robust, secure, and tested rigorously. Financial institutions now hire ethical hackers and AI safety experts to prevent catastrophic failures. The risk is no longer just human error, it is machine misjudgment at global scale. Governments and regulators are watching closely. Some countries have started requiring audit trails for AI trading decisions. There are discussions about circuit breakers that pause AI trading during abnormal market behavior. Transparency, accountability, and ethical AI practices are becoming core themes in the regulatory landscape. But staying ahead of AI evolution is nearly impossible for human lawmakers. It is a race between innovation and oversight, with massive consequences for public trust and economic stability. 2. AI-powered trading. Beating Wall Street at its own game. Trading used to be an art. Floor traders in suits shouted bids and offers, moved by instinct, rumors, and adrenaline. Deals were made on handshakes and hunches. But that world has changed forever. Today, trading is more science than art, more algorithm than emotion. The rise of artificial intelligence has turned the battlefield digital. Now, Machines race against each other in milliseconds, reacting to data streams humans can barely comprehend. Wall Street, once ruled by charisma and connections, now bows to code. In this new arena, AI-powered trading systems do not just participate, they dominate. At the heart of this transformation is algorithmic trading, where pre-programmed instructions execute trades based on defined parameters. These algorithms consider price, volume, timing, and even complex mathematical models to buy or sell assets at optimal points. But AI has taken this further. Unlike static algorithms, AI systems learn. They adapt. They evolve. Using historical data, they recognize patterns that suggest future movements. If a stock typically rises after a certain news pattern or currency pair shifts after specific market behavior, the AI notices and acts. Often, it moves before the market even realizes what is happening. One of the most aggressive forms of AI trading is high-frequency trading, HFT. These are ultra-fast systems that execute thousands of trades per second. HFT firms leverage colocation, physically placing their servers close to stock exchange data centers, to gain microsecond advantages. AI enhances this further by scanning news feeds, social media, and global indicators in real time to detect triggers. If an oil pipeline explodes in Libya, or a tech CEO tweets unexpectedly, the AI bot reacts before a human even reads the headline. In these milliseconds, fortunes are made and lost. The market is no longer slow and rational, it is lightning fast and reactive. Natural language processing, NLP, has also entered the trading game. I can now read, interpret, and act on financial news, earnings reports, and social media sentiment in real time. For example, a sudden spike in negative words in a company's earnings call might trigger an automatic short. A positive tweet from a key influencer could trigger a buy order across thousands of accounts. Human traders used to listen to CNBC for cues. AI reads everything, all the time. It understands nuance, sarcasm, urgency. It quantifies the mood of the market, something humans can only guess. Predictive analytics powered by deep learning is another secret weapon. These systems take in massive historical data, prices, charts, volume, volatility, and try to forecast where assets are likely to move. Unlike traditional indicators that use fixed logic like RSI or MACD, AI learns from each new data point. It identifies seasonality, geopolitical effects, correlations, and nonlinear anomalies. Over time, it builds a probabilistic model of future price action. Traders using these AI tools are no longer reacting to the market, they are anticipating it. They are operating with vision, not just visibility. AI has even changed portfolio management strategies. Traditional models like modern portfolio theory or efficient market hypothesis have limitations in today's chaotic, data-heavy markets. AI can process thousands of factors simultaneously, from currency fluctuations to weather patterns to social unrest, and reallocate assets dynamically. This is the rise of quant funds, hedge funds run not by humans but by algorithms. These funds continuously rebalance based on real-time data. Some funds even use reinforcement learning, where AI tries strategies, learns from results, and refines its actions over time. These models improve themselves with every market tick. A significant evolution is happening in risk management. In the old days, risk was assessed by VAR models and historical volatility. But today's AI systems detect risk in real time. If volatility starts rising in correlated sectors, AI might reduce exposure even before losses occur. If two assets show abnormal inverse behavior, AI raises alerts. It does not just look at financial data, it includes geopolitical headlines, satellite imagery, and even weather forecasts to calculate exposure. This kind of multidimensional risk assessment is reshaping how portfolios are protected. Retail investors have also gained access to AI tools that once belonged only to hedge funds. Apps now offer AI-powered robo-advisors that build and manage investment portfolios for individuals using the same logic as institutional systems. These platforms consider user goals, timelines, risk appetite, and market conditions to auto-adjust portfolios. This means even someone with no financial background can participate in intelligent, dynamic investing. AI is not just beating Wall Street, it is putting its power into the pockets of everyday people. Still, not everything is flawless. One major concern with AI-driven trading is herd behavior. When multiple AI systems identify the same opportunity and act simultaneously, it can cause massive market swings, creating volatility from nothing. We saw this in the 2010 flash crash and smaller incidents since. Moreover, because many AI models are black boxes, it is hard to understand exactly why a system made a trade. This lack of transparency makes regulation and trust difficult. When trades happen faster than thought, who do you blame when things go wrong? Another concern is the arms race among firms to build faster and smarter systems. Billions are being spent on better infrastructure, low-latency networks, and exclusive data feeds. The richest firms with the best engineers dominate the game. This creates a growing inequality in financial markets. While AI tools are democratizing access in some areas, the top layer of AI-powered trading remains highly exclusive, benefiting a few powerful players. The game has changed, but not everyone is playing on equal terms. Cybersecurity has also become a critical issue. With so many trading decisions automated, a malicious hack or error in code could cause a systemic crash. Imagine a rogue algorithm misinterpreting a diplomatic speech as a threat, triggering a massive sell-off across global markets. AI systems must be robust, secure, and tested rigorously. Financial institutions now hire ethical hackers and AI safety experts to prevent catastrophic failures. The risk is no longer just human error, it is machine misjudgment at global scale. Governments and regulators are watching closely. Some countries have started requiring audit trails for AI trading decisions. There are discussions about circuit breakers that pause AI trading during abnormal market behavior. Transparency, accountability, and ethical AI practices are becoming core themes in the regulatory landscape. But staying ahead of AI evolution is nearly impossible for human lawmakers. It is a race between innovation and oversight, with massive consequences for public trust and economic stability. The psychology of markets is also shifting. Traders now talk about machine psychology, how ICE might interpret patterns, how they might respond to stimuli, and how to predict their behavior. Ironically, humans are now trying to understand machines in the same way they once tried to understand crowd emotions. Strategies are being developed not just to trade with AI, but to exploit its blind spots. Meta AI strategies are emerging, algorithms that predict the actions of other algorithms. It is no longer just trading. It is warfare in code. Yet with all its risks, AI-powered trading has brought enormous efficiency and liquidity to markets. Spreads are tighter, execution is faster, and price discovery is more accurate. The global financial system has become more connected, more reactive, and more data-driven. Traders who embrace AI find themselves with superhuman capabilities. Those who resist are increasingly left behind. This is not just a shift in technology, it is a shift in power, philosophy, and the very fabric of financial markets. In the end, AI is not beating Wall Street, it is becoming Wall Street. The battleground has shifted from human judgment to computational supremacy. The traders of tomorrow are not men in suits shouting across trading floors. They are engineers in hoodies writing code in dark rooms. And the real action? It is happening in server farms, fiber optic cables, and neural networks. Welcome to the new Wall Street, where machines do not sleep and the markets never blink. 3. Robo-advisors versus human financial experts. How AI-based robo-advisors are creating personalized investment portfolios and whether they outperform traditional human advisors. There was a time when financial advice was something reserved for the wealthy, private bankers in suits, face-to-face meetings, and stacks of documents outlining complicated portfolios. Enter the modern age, and artificial intelligence has completely changed this narrative. Robo-advisors are algorithm-driven platforms that offer investment advice with minimal human supervision. They use data, lots of it, from market trends, your income, your risk appetite, and even your lifestyle choices. In return, They offer portfolio recommendations tailored just for you. No small talk, no office visits, just precision-driven, always-on guidance. The rise of robo-advisors signals a shift in how financial advice is delivered and consumed. Platforms like Betterment, Wealthfront, and even hybrid models like Vanguard's personal advisor services have become household names. These AI-powered advisors evaluate vast amounts of data in seconds, assessing your financial goals, evaluating hundreds of ETFs, and allocating assets based on preset logic models. They continuously rebalance your portfolio, react to market movements, and adjust your allocations to optimize performance. For many investors, this level of automation feels like magic, but it is all mathematics and machine learning. One of the key advantages of robo-advisors is their accessibility. Unlike human advisors who often require a minimum account size or charge high fees, robo-advisors are democratizing investing. A college student with $100 can start investing with the same quality of strategy that a millionaire might receive. Plus, these platforms operate 24/7. Whether it is midnight or Monday morning, you can check your financial health, adjust goals, or get AI-powered insights without booking an appointment. Convenience and consistency, two things traditional advisors cannot always offer. But it is not just about convenience. AI-based robo-advisors have also proven to be impressively accurate when it comes to risk profiling. They do not rely on a quick chat or a questionnaire alone. Many platforms use behavioral analysis, pattern recognition, and even psychological modeling to understand what kind of investor you really are. If your spending habits suggest you're a risk-averse person, the system adjusts accordingly. It is not just smart, it is sensitive. And in the volatile world of markets, that sensitivity can be the difference between gains and losses. Now comes the big question. Do robo-advisors perform better than humans? The answer is complicated. In terms of consistency, speed, and data analysis, AI wins hands down. It does not get emotional, does not panic, and never sleeps. It also does not try to beat the market with intuition. It plays the long game using facts. That alone makes robo-advisors suitable for passive investors. But for active investors seeking alpha, who want to chase high-growth stocks or ride short-term trends, human advisors still have an edge. Their intuition, experience, and network provide them with insights AI cannot yet replicate. There is also the human touch to consider. Many clients still prefer having a real person to talk to, especially during market crashes or economic crises. No matter how smart AI becomes, it cannot offer empathy, reassurance, or hand-holding. During the COVID-19 crash, for instance, robo-advisors executed sell or rebalance orders based on logic. Some investors appreciated this discipline. Others, panicked by the drop, wished for a human voice to calm their nerves. This emotional support is a crucial part of wealth management, something no algorithm, no matter how advanced, can fully offer. Still, the hybrid model is emerging as the future. Several platforms now combine robo-advisors with access to human experts. The AI does the heavy lifting, data crunching, allocation, rebalancing, while humans step in for nuanced conversations, estate planning, or tax strategies. This blend offers the best of both worlds, machine efficiency with human understanding. It shows that AI is not replacing humans in finance, it is evolving the role of the human advisor, making them more strategic and less mechanical. Security and privacy also matter. Robo-advisors handle a vast amount of personal and financial data, making them potential targets for cyber attacks. To combat this, AI models are layered with encryption, behavior-based access control, and real-time anomaly detection. This makes them arguably safer than some traditional systems that rely on manual processes. However, as with all tech platforms, trust depends on transparency. Users want to know how decisions are made, how data is used, and what fail-safes exist in case of errors or fraud. Another noteworthy benefit of robo-advisors is cost efficiency. Traditional human advisors often charge 1% to 2% of assets under management annually. Robo-advisors operate at a fraction of that, some even under 0.25%. For long-term investors, these savings compound significantly over decades. This makes them a compelling option for those who believe in low-cost, long-term investing. Add in features like automatic tax loss harvesting, goal tracking, and mobile accessibility, and it is clear why millions are switching. Ultimately, the rise of robo-advisors is not about replacing humans, it is about reimagining financial advice. AI brings scalability, objectivity, and personalization to a space once dominated by exclusivity and emotion. Whether or not robo-advisors beat humans depends on the investor's needs. But one thing is certain. In the future of finance, algorithms will sit right beside advisors, not to compete, but to collaborate. And in that partnership, the investor stands to gain the most. 4. Smart fraud detection and risk management. Machine learning models and neural networks are transforming how banks detect fraud, suspicious activities, and credit risks in real time. Fraud is a huge challenge in global finance, causing massive losses and damaging trust. Traditional methods based on fixed rules became ineffective as criminals grew more sophisticated. AI systems now analyze vast amounts of data continuously, spotting anomalies that humans cannot catch. These models learn from patterns of legitimate behavior and identify deviations instantly, enabling faster responses. AI does not just flag obvious frauds but detects subtle, evolving patterns. For example, it can spot when a user's spending habits suddenly change or when a transaction comes from an unusual device or location. Such behavior-based detection reduces false alarms and improves accuracy. Banks now use real-time AI monitoring dashboards, enabling security teams to act immediately. This rapid detection is crucial for minimizing losses and protecting customers' assets. Machine learning models also help predict credit risk more accurately than traditional scoring systems. They consider multiple factors, transaction histories, payment behaviors, social data, even macroeconomic trends, to assess a borrower's likelihood of default. This enables lenders to offer personalized loan terms and interest rates, reducing their exposure. AI-powered credit scoring improves financial inclusion by evaluating borrowers who lack conventional credit histories, using alternative data sources. Neural networks enable fraud systems to adapt quickly. As fraudsters change their tactics, these AI models update themselves by retraining on new data. This continuous learning helps prevent the system from becoming outdated or vulnerable. For example, in detecting synthetic identities, fake profiles built from real and fabricated information, AI can identify inconsistencies invisible to rule-based systems. This adaptability is key to staying ahead of sophisticated cybercriminals. In payment processing, AI monitors thousands of transactions every second, assessing risks in real time. Suspicious payments can be automatically flagged or blocked, depending on risk levels. For digital wallets and mobile banking apps, AI adds an extra layer of security by analyzing user behaviors and device fingerprints. This protects customers from account takeovers and phishing attacks. AI-driven authentication methods, such as biometric recognition and behavioral analytics, are becoming standard. Fraud detection powered by AI reduces costs significantly. Manual review of flagged transactions used to require large teams working around the clock. AI automates much of this workload, allowing human experts to focus on the most complex cases. This increases efficiency and reduces operational expenses. Moreover, faster fraud detection means quicker reimbursements for customers, improving satisfaction and trust in financial institutions. AI is also used in anti-money laundering (AML) efforts. It scans transaction chains to identify suspicious money flows and connections to known illicit actors. By mapping networks of transactions, AI helps regulators and banks uncover hidden financial crimes. This deep network analysis was nearly impossible before AI tools became available. Automated reporting of suspicious activities helps institutions comply with regulatory requirements and avoid hefty fines. However, AI-based fraud detection is not without challenges. Data privacy concerns arise because these systems require access to vast amounts of personal information. Institutions must balance security needs with compliance to data protection laws like GDPR. Transparency is also crucial. Customers want to know how their data is used and how AI decisions are made. Explainable AI techniques are being developed to address these issues, providing insights into AI's reasoning. Collaboration between financial institutions, governments, and technology providers is essential. Sharing anonymized fraud data helps improve AI models globally, strengthening defenses against emerging threats. Open innovation and data partnerships enable faster detection of cross-border fraud schemes. The future of smart fraud detection depends on this collective intelligence, where AI systems learn from diverse data sources while respecting privacy. Looking ahead, advances in quantum computing promise to accelerate AI's fraud detection capabilities even further. Quantum algorithms can analyze complex financial networks and patterns at unprecedented speeds, uncovering frauds that classical computers might miss. However, this also means fraudsters will develop new attack methods. Continuous AI model updates, regulatory oversight, and human expertise will remain vital. Together, they ensure that finance stays one step ahead of fraudsters in an ever-changing digital landscape. Beyond detection, AI-driven risk management systems also help financial institutions predict potential future vulnerabilities. By analyzing market conditions, customer behavior trends, and geopolitical events, AI can forecast periods of increased fraud risk or financial instability. This proactive approach allows banks to strengthen defenses before attacks happen. For example, during major global events or economic downturns, AI systems increase monitoring sensitivity to spot unusual spikes in suspicious activities. This dynamic adaptation improves overall security posture. Furthermore, AI facilitates automated incident response once fraud is detected. Instead of waiting for human approval, certain AI protocols can freeze accounts, block transactions, or request additional verification immediately. This rapid reaction minimizes damage and stops fraud in its tracks. Automated response also frees up cybersecurity teams to focus on complex investigations rather than routine alerts. It represents a paradigm shift from reactive to preventive financial security, powered by real-time intelligence. The integration of AI with blockchain technology is another emerging frontier in fraud prevention. Blockchain's transparent, immutable ledger combined with AI's analytical power creates a robust ecosystem for verifying transaction legitimacy. AI can analyze blockchain data patterns to flag abnormal transactions or wallets linked to illicit activities. This combination enhances traceability and accountability, making fraud attempts easier to detect and harder to execute. Financial regulators are increasingly exploring this synergy to bolster anti-fraud frameworks. Customer education supported by AI insights is also critical in combating fraud. Many fraud attempts exploit human error or lack of awareness. AI-powered chatbots and personalized alerts educate customers about suspicious activity patterns and recommend security best practices. This empowers users to recognize and report potential threats early. The more informed customers become, the stronger the collective defense against fraud becomes, closing the human factor gap in financial security. Finally, ethical considerations guide the deployment of AI in fraud detection. Financial institutions must ensure that AI systems do not inadvertently discriminate or unfairly target certain customer groups. Bias in training data can lead to false positives or negatives, harming innocent users or allowing fraud to slip through. Regular audits, diverse datasets, and transparency protocols are essential to maintain fairness and trust. Ethical AI use in fraud prevention strengthens both security and customer confidence in an increasingly automated financial world. 5. AI in banking. Automation and hyper-personalization. Banks today are leveraging artificial intelligence to revolutionize the customer experience by making services more automated and personalized than ever before. Automation has streamlined many traditional banking processes, reducing wait times and improving accuracy. AI-driven chatbots and virtual assistants now handle millions of customer inquiries daily, providing instant support for account information, transactions, and troubleshooting. These systems learn from interactions to offer increasingly relevant and helpful responses, delivering 24/7 service without human limitations. Loan approvals, once a lengthy and manual process, have been transformed by AI algorithms that assess creditworthiness quickly and fairly. By analyzing a wide range of data points beyond traditional credit scores, such as transaction histories, employment patterns, and even social behaviors, AI models can approve loans within minutes. This speeds up access to funds for customers and reduces risk for banks by making more informed decisions. Hyper-personalized loan offers tailored to individual financial profiles are becoming standard, increasing customer satisfaction. Financial planning tools powered by AI are also gaining prominence in banking. These platforms analyze customers' spending habits, income flows, and saving goals to provide personalized advice and actionable insights. Unlike generic financial guidance, AI-driven plans adjust dynamically with changing life circumstances, market conditions, and new financial products. Banks offer these hyper-personalized tools through apps and online dashboards, enabling customers to take control of their finances with confidence and clarity. Beyond front-end services, AI is automating many back-office operations within banks. Routine tasks such as data entry, compliance checks, and fraud monitoring are now handled by intelligent systems, freeing employees to focus on higher-value work. Automation improves operational efficiency and reduces human error, enabling banks to cut costs while maintaining high standards. This shift is also accelerating innovation cycles, allowing banks to bring new products and services to market faster than ever. Customer data is at the heart of AI-powered hyper-personalization. Banks collect and analyze enormous volumes of data, from transaction records to social media behavior, to build detailed customer profiles. This data is used not only to personalize product recommendations but also to tailor marketing campaigns and customer communications. AI systems can predict customer needs before they arise, suggesting relevant services that enhance engagement and loyalty. This proactive approach is changing how banks interact with their clients. AI also enhances accessibility and inclusion in banking services. By analyzing non-traditional data, AI enables banks to serve underbanked or previously excluded populations with customized financial products. For instance, AI can assess creditworthiness for individuals lacking formal credit histories, opening access to loans and savings products. Language processing technologies help break down communication barriers, providing multilingual support and easy-to-understand financial advice. This democratization of banking fosters greater financial inclusion worldwide. Personalization is not limited to products but extends to security as well. AI systems analyze user behavior to create adaptive authentication measures, such as biometric recognition and risk-based login protocols. These hyper-personalized security features balance convenience and protection, reducing fraud without frustrating customers. By understanding typical user patterns, AI can flag unusual access attempts instantly, protecting both users and banks in real time. AI-powered predictive analytics allow banks to anticipate market changes and customer demands more accurately. By continuously analyzing economic indicators, competitor actions, and consumer trends, AI helps banks adjust strategies proactively. This agility improves resilience in volatile markets and ensures services remain relevant. Whether launching new credit products or adjusting interest rates, AI insights guide decision-making for optimal outcomes. Banks are also investing in AI-driven customer journey mapping. This technology visualizes every interaction a customer has with the bank across multiple channels. By analyzing this data, banks identify pain points and opportunities to improve service delivery. The result is a seamless, consistent experience whether customers engage via mobile app, branch visit, or call center. Hyper-personalization becomes a holistic effort that enhances satisfaction and builds long-term relationships. Finally, ethical AI deployment in banking remains paramount. Banks must ensure transparency in how AI decisions affect customers, especially regarding loan approvals and personalized offers. Data privacy and security protections are critical to maintain trust. Many institutions adopt explainable AI frameworks and regular audits to monitor biases and ensure fairness. When done right, AI-powered automation and hyper-personalization redefine banking as a customer-centric, efficient, and inclusive industry of the future. AI is also playing a vital role in transforming customer onboarding processes in banking. Traditionally, onboarding involved multiple manual steps and extensive paperwork, leading to delays and customer frustration. With AI, banks are automating identity verification using facial recognition, document scanning, and biometric authentication. This not only speeds up account opening but also reduces errors and fraud risks. Customers can now open accounts remotely in minutes, enjoying a frictionless experience that builds early trust. Moreover, AI-driven sentiment analysis tools help banks gauge customer satisfaction in real time. By analyzing feedback from surveys, social media, and call center interactions, AI identifies trends and pain points before they escalate. Banks can then proactively address issues and tailor communications to improve relationships. This real-time feedback loop enables a customer-centric approach where services evolve based on genuine user needs, fostering loyalty and retention. Cross-selling and upselling efforts benefit greatly from AI's deep insights into customer behavior. Instead of generic marketing campaigns, AI creates highly targeted offers that resonate with individual preferences and life stages. Whether it is recommending a mortgage after a customer's home search or suggesting retirement plans as they approach midlife, AI personalizes the timing and content of financial products. This precision marketing increases conversion rates while enhancing the customer's perceived value of the bank's offerings. AI's integration with Internet of Things, IoT, devices is opening new frontiers in personalized banking experiences. Smart devices, such as wearables and home assistants, collect financial behavior data that AI can analyze to provide contextual advice. For instance, a wearable tracking spending habits might prompt a savings suggestion or alert to unusual expenditures. This real-time, context-aware guidance brings financial wellness support into customers' daily lives in a seamless and natural way. Collaboration between banks and fintech startups is accelerating AI innovation in hyper-personalization. Fintech companies often bring agile development and cutting-edge AI techniques that legacy banks integrate to enhance their services. This partnership ecosystem fosters rapid experimentation and deployment of new features like voice banking, AI financial coaches, and advanced risk models. As a result, customers benefit from the best of both worlds, trusted institutions combined with innovative technology. Banks also use AI to optimize branch operations and staff allocation. By analyzing customer footfall patterns, transaction volumes, and service preferences, AI helps managers schedule the right number of employees at peak times. This reduces waiting times and improves the in-branch experience. Some banks employ AI-powered robots for routine tasks like information provision or simple transactions, freeing human staff to focus on complex customer needs, blending automation with human touch effectively. Another important aspect of AI in banking personalization is regulatory compliance. Banks operate under strict rules to protect customers and financial stability. AI systems help automate compliance checks and reporting, ensuring that personalized offers and automated decisions meet legal standards. This reduces risks of regulatory penalties and builds confidence among stakeholders. Compliance automation also accelerates product launches while maintaining governance and transparency. Personalized financial education powered by AI is emerging as a critical tool to improve financial literacy. Banks use AI to create tailored learning modules based on customers' knowledge gaps, financial goals, and life stages. Interactive chatbots can guide users through budgeting, investing, or debt management with customized content. This approach empowers customers to make informed decisions, enhancing long-term financial health and reducing dependence on reactive support. AI-driven customer segmentation goes beyond demographics, analyzing psychographic and behavioral data to create nuanced profiles. This allows banks to design hyper-targeted loyalty programs, rewards, and incentives. For example, young professionals may receive investment advice, while retirees get personalized pension planning support. These segmented experiences increase engagement and build emotional connections, turning customers into advocates for the bank. Finally, as AI adoption grows, banks must prioritize data ethics and transparency in personalization strategies. Customers demand clear explanations of how their data is used and want control over privacy settings. Banks adopting responsible AI frameworks demonstrate commitment to ethical standards, which fosters trust and brand loyalty. Balancing hyper-personalization with privacy protections is the challenge and opportunity shaping the future of AI in banking. 6. AI and the credit scoring revolution. Credit scoring has traditionally relied on limited datasets such as payment history, outstanding debt, and credit utilization ratios to assess a borrower's creditworthiness. These conventional models, while widely used, have significant limitations. They often exclude large segments of the population who lack comprehensive credit histories, such as young adults, freelancers, or individuals in emerging markets. Furthermore, traditional credit scores can sometimes be biased against certain demographic groups due to the nature of the historical data they depend on. Artificial intelligence is revolutionizing this space by bringing more comprehensive, accurate, and fair credit assessments that expand financial access. AI-based credit scoring models use a diverse range of data points that go beyond standard financial records. They analyze non-traditional data such as utility payments, rental history, educational background, employment stability, and even behavioral data gathered from social media or smartphone usage patterns. By incorporating this wide array of information, AI algorithms generate a more holistic view of a borrower's financial responsibility. This enables lenders to make decisions based on real-time, dynamic data rather than static snapshots, improving accuracy and reducing default rates. One of the greatest advantages of AI in credit scoring is its ability to detect subtle patterns and correlations invisible to traditional models. Machine learning techniques enable continuous learning from vast datasets, adapting to changing economic conditions and borrower behaviors. This adaptability helps AI models forecast repayment likelihood with higher precision, enabling lenders to offer better rates to low-risk customers while managing exposure more effectively. In contrast, traditional models are often rigid and slow to respond to new market realities. Fairness and inclusion are also critical benefits of AI-driven credit scoring. Many traditional credit systems inadvertently perpetuate socioeconomic inequalities by relying heavily on data reflecting past biases. AI models, when properly designed, can mitigate these biases by using algorithms trained on diverse datasets and incorporating fairness constraints. This ensures that minority groups, women, or people from underserved regions are evaluated more equitably. Expanding credit access to these groups not only drives financial inclusion but also stimulates broader economic growth. The use of AI-powered credit scoring is particularly impactful in emerging economies, where formal credit systems are underdeveloped. Many individuals lack traditional credit histories, which makes them invisible to legacy scoring models. AI can analyze alternative data sources like mobile phone records, e-commerce transactions, and community networks to build trustworthy credit profiles. This innovation is enabling millions of previously excluded consumers to access credit, fueling entrepreneurship and improving livelihoods in these regions. Despite its advantages, AI-based credit scoring also raises important ethical and regulatory questions. Transparency is a major concern as many AI models operate as black boxes, making it difficult to explain how decisions are made. Borrowers and regulators demand clear explanations for loan denials and credit limits to ensure fairness and accountability. Financial institutions must invest in explainable AI techniques and rigorous auditing to maintain trust and comply with evolving regulations. Privacy is another crucial issue. AI credit scoring involves processing vast amounts of sensitive personal data, raising risks related to data security and misuse. Banks and fintech companies must implement robust data protection frameworks, anonymize sensitive information where possible, and seek explicit consent from consumers. Striking the right balance between leveraging data for accuracy and protecting individual privacy is essential for sustainable adoption. AI's impact on credit scoring is also transforming the competitive landscape in financial services. Traditional banks face increasing pressure from fintech startups that use AI to offer faster, more flexible lending options. These new entrants often provide instant credit decisions with minimal paperwork, appealing especially to younger, tech-savvy consumers. To stay competitive, established lenders are integrating AI capabilities into their workflows, enhancing their speed, efficiency, and customer experience. Furthermore, AI enables ongoing credit risk monitoring rather than a one-time assessment. Models continuously analyze borrower behavior and external factors, allowing lenders to adjust credit limits or offer financial counseling proactively. This dynamic risk management approach reduces defaults and helps borrowers maintain healthy credit profiles. It represents a shift from reactive lending to a more supportive, customer-centric model enabled by continuous AI oversight. In conclusion, AI is fundamentally reshaping credit scoring by delivering more accurate, inclusive, and fair assessments that benefit both lenders and borrowers. It expands access to credit for underserved populations, improves risk prediction, and fosters financial innovation. However, ethical use, transparency, and data privacy remain critical to ensure that this revolution leads to sustainable and equitable financial systems worldwide. As AI continues to evolve, it promises to make credit evaluation smarter, faster, and more humane, opening new horizons for global finance. Another important aspect of AI-powered credit scoring is its role in reducing human biases that have historically influenced lending decisions. Traditional credit officers may consciously or unconsciously let personal prejudices affect their judgments, leading to inconsistent or unfair outcomes. AI models, when properly trained and audited, offer objective evaluations based purely on data patterns. This not only ensures consistency but also increases trust among applicants who may have faced discrimination in the past. However, ongoing oversight is essential to ensure the AI itself does not inherit biased data or decision-making criteria. The integration of AI credit scoring with other financial technologies also enhances the borrowing experience. For example, AI-powered chatbots can guide applicants through the loan process, explaining credit decisions in simple language and helping them improve their creditworthiness. Some platforms offer personalized financial education tailored to an individual's credit profile, empowering borrowers to make smarter financial choices. This combination of AI scoring and support tools transforms credit from a gatekeeping mechanism into a pathway for financial empowerment. Moreover, AI is facilitating innovative credit products that traditional scoring could not support. Pay-as-you-go credit models, microloans, and peer-to-peer lending platforms use AI algorithms to evaluate risk and price loans dynamically. These flexible models help meet the needs of gig workers, freelancers, and small businesses whose income streams are variable or irregular. By expanding credit products tailored to diverse customer profiles, AI is democratizing access to capital and fostering economic resilience. Regulators worldwide are increasingly focused on how AI influences credit scoring practices. Regulatory frameworks are evolving to ensure that AI models meet standards for fairness, transparency, and consumer protection. For example, the European Union's AI Act and the Consumer Financial Protection Bureau's guidelines in the United States emphasize explainability and bias mitigation. Banks and fintech firms must align their AI systems with these regulations to avoid legal risks and maintain consumer confidence. This regulatory scrutiny is driving innovation in responsible AI development. AI credit scoring also enables real-time credit updates, reflecting changes in borrowers' financial situations immediately. Traditional scores are often updated monthly or quarterly, which can leave lenders and borrowers out of sync with current realities. Real-time updates allow lenders to adjust credit terms dynamically, such as increasing limits for improving customers or flagging risks early to prevent defaults. This responsiveness supports healthier credit ecosystems and promotes more sustainable lending practices. The environmental, social, and governance (ESG) implications of AI in credit scoring are gaining attention. By providing more equitable credit access, AI contributes to social inclusion and economic development goals. However, the environmental footprint of large-scale AI computations and data centers also requires consideration. Financial institutions are increasingly adopting green AI strategies, optimizing algorithms for energy efficiency while maintaining performance. Balancing AI innovation with ESG commitments is becoming a priority for the finance sector. Cross-border credit scoring is another frontier where AI shows great promise. Globalization and increased migration create challenges for credit evaluation across different financial systems. AI models trained on diverse international data can assess creditworthiness of immigrants or expatriates more accurately than traditional methods. This supports global mobility and opens new markets for lenders, fostering inclusive finance on a global scale. Partnerships between traditional banks, fintech startups, and data providers are accelerating the development of AI credit scoring solutions. By pooling expertise and resources, these collaborations create robust models that leverage diverse datasets and advanced analytics. Joint innovation hubs and AI labs are emerging as hotspots for developing next-generation credit scoring tools. This ecosystem approach enhances the scalability and reliability of AI credit assessments, benefiting the entire financial industry. Looking ahead, advances in explainable AI, (XAI), will further enhance trust and adoption of AI credit scoring. XAI techniques aim to make complex AI decisions understandable to both lenders and borrowers. Transparent models allow applicants to see why they received certain scores and what actions can improve them. This openness fosters accountability and empowers consumers, transforming credit scoring into a collaborative and transparent process. In summary, the AI-driven credit scoring revolution is reshaping how creditworthiness is evaluated by combining accuracy, fairness, and inclusivity. It leverages diverse data sources, continuous learning, and ethical frameworks to deliver smarter lending decisions. This evolution not only expands financial access but also improves risk management, regulatory compliance, and customer empowerment. As AI technologies mature, they will continue to drive innovation in credit scoring, creating a more equitable and efficient financial landscape worldwide. 7. The role of AI in cryptocurrency and DeFi. Artificial intelligence is playing an increasingly transformative role in the world of cryptocurrency and decentralized finance, or DeFi. The crypto market is notoriously volatile and complex, making it a perfect playground for AI technologies that can analyze massive amounts of data in real time and execute trades or decisions with precision. AI-powered crypto trading bots are now widely used by individual investors and institutional players alike to capitalize on fleeting market opportunities. These bots use machine learning algorithms to identify patterns, execute trades faster than humans, and optimize portfolio performance. Sentiment analysis is another powerful AI application reshaping cryptocurrency markets. By analyzing social media trends, news articles, forum discussions, and even influencer activity, AI models can gauge market sentiment and predict price movements more accurately. This is crucial in crypto, where market psychology and hype often drive price swings. Sentiment analysis tools provide investors with real-time insights into public perception, enabling smarter, data-driven trading decisions and risk management. This level of analysis was nearly impossible before AI advances. Decentralized finance systems benefit significantly from AI integration as well. DeFi platforms rely on smart contracts to facilitate peer-to-peer financial services without intermediaries, but managing risk, liquidity, and fraud in these open systems is challenging. AI helps by automating risk assessment, detecting anomalies, and optimizing liquidity pools. For example, AI can predict potential defaults or market manipulations on DeFi lending platforms and trigger safeguards automatically. This increases trust and stability in a system built on transparency and decentralization. The future potential of AI in crypto and DeFi is vast. As AI models become more sophisticated, they will enable fully autonomous investment strategies that adapt to changing market conditions without human intervention. These AI agents could manage diversified portfolios, rebalance assets dynamically, and execute yield farming strategies across multiple DeFi protocols to maximize returns. This level of automation promises to democratize access to complex financial strategies previously limited to hedge funds and institutional investors. AI also enhances security in the crypto space. With the rise of hacks and scams, AI-based systems monitor blockchain transactions in real time to identify suspicious activity, phishing attempts, or fraudulent token listings. Machine learning models improve continuously by learning from past attacks, making detection systems more robust and proactive. This proactive security layer is vital for protecting investors and maintaining confidence in decentralized ecosystems. Governance in decentralized autonomous organizations, DAOs, is another area where AI shows promise. DAOs rely on community voting to make decisions, but the process can be slow and inefficient. AI can analyze proposals, predict outcomes, and facilitate consensus building by providing data-driven recommendations. This helps streamline governance, ensuring more effective and timely decision-making in decentralized projects. Moreover, AI can assist in regulatory compliance for crypto exchanges and DeFi platforms. Navigating complex and evolving regulations is a major challenge for these entities. AI-powered compliance tools automate monitoring of transactions, flagging suspicious behavior and ensuring adherence to anti-money laundering (AML) and Know Your Customer (KYC) requirements. This helps platforms operate legally while reducing operational costs. Token valuation and ICO analysis also benefit from AI technologies. By examining market data, project fundamentals, team credibility, and social sentiment, AI models assess the potential success of new tokens or initial coin offerings. This assists investors in making informed choices and avoiding scams or overhyped projects. AI's ability to sift through vast amounts of data gives it a significant edge over manual analysis. In summary, AI is revolutionizing cryptocurrency and DeFi by bringing automation, predictive power, enhanced security, and improved governance. Its ability to analyze complex datasets in real time and make intelligent decisions is unlocking new efficiencies and opportunities in these rapidly evolving markets. As AI continues to evolve, it will play a crucial role in shaping the future of decentralized finance, making it more accessible, secure, and efficient for everyone involved. AI's integration into cryptocurrency and DeFi also fosters innovation in personalized financial services. Unlike traditional finance, where products can be rigid and one-size-fits-all, AI-driven platforms can tailor investment strategies and lending terms based on individual risk profiles, transaction histories, and behavioral data. This customization allows users to participate in DeFi with greater confidence and flexibility. Personalized AI advisors can guide users through complex DeFi protocols, helping them optimize yields, minimize risks, and understand intricate mechanisms like staking, liquidity mining, or automated market making. Furthermore, AI is critical in enhancing interoperability among different blockchain networks. The decentralized finance ecosystem is highly fragmented, with numerous blockchains and protocols operating independently. AI algorithms facilitate seamless cross-chain transactions by predicting network congestion, optimizing routing paths, and managing fees dynamically. This interoperability boosts liquidity and efficiency across DeFi platforms, allowing users to move assets and leverage financial services across multiple networks with minimal friction. The data-driven insights AI provides are invaluable for market makers and liquidity providers in decentralized exchanges (DEXs). AI models can predict demand fluctuations, set dynamic pricing, and balance liquidity pools to maximize profitability and reduce slippage. These intelligent algorithms help maintain stable markets in highly volatile environments, improving the overall trading experience for users. As DEXs grow in popularity, AI's role in optimizing liquidity and pricing strategies becomes increasingly vital. AI also plays a pivotal role in fostering transparency and auditability in decentralized systems. Blockchain's inherent transparency is enhanced by AI-powered analytics that monitor network activity, smart contract executions, and token flows. These tools detect irregular patterns, verify compliance with protocol rules, and ensure the integrity of financial operations. By providing real-time, AI-driven insights, stakeholders can make more informed decisions and respond quickly to emerging risks or opportunities. The scalability challenges of blockchain technology are being addressed, in part, by AI innovations. AI can optimize transaction validation processes, predict network load, and assist in managing on-chain resources more efficiently. These improvements help reduce transaction costs and latency, making decentralized finance more practical for everyday users. As scalability solutions evolve, AI will continue to be instrumental in refining blockchain infrastructure and enhancing user experience. Ethical considerations around AI's role in cryptocurrency and DeFi are gaining prominence. The decentralized nature of these systems demands transparency and accountability from AI implementations. Ensuring that AI algorithms do not inadvertently enable manipulative behaviors, market manipulation, or unfair advantages is critical. Developers and regulators must collaborate to establish standards and best practices that promote ethical AI use, safeguarding the interests of all participants in the crypto ecosystem. In addition, AI facilitates the creation of new financial products in the crypto space. For example, AI-driven prediction markets enable users to speculate on future events, from price movements to global economic indicators, using decentralized platforms. These markets rely on collective intelligence augmented by AI to generate accurate forecasts and provide liquidity. Such innovations broaden the scope of decentralized finance and open new avenues for investment and risk management. AI's role in enhancing user experience cannot be overstated. User-friendly interfaces powered by AI simplify navigation of complex DeFi protocols, helping users manage portfolios, track performance, and execute transactions with ease. Natural language processing, NLP, allows users to interact with platforms via voice or chat, making decentralized finance accessible even to those without technical expertise. This democratization of finance through AI lowers barriers and accelerates adoption. Finally, the synergy between AI and blockchain technology promises to drive the next wave of financial innovation. As AI algorithms grow more capable and blockchain platforms become more scalable, the integration of these technologies will unlock unprecedented levels of automation, security, and customization. Together, they are poised to redefine global finance by creating decentralized, intelligent systems that empower individuals and institutions alike. AI's impact on decentralized lending protocols is another game-changer in the crypto space. Traditionally, lending relies heavily on credit history and collateral evaluation, but in DeFi, trustless lending requires new approaches. AI algorithms analyze on-chain data such as transaction history, wallet behavior, and network reputation to assess borrower credibility. This dynamic, data-driven risk assessment enables lenders to offer loans without traditional collateral, expanding financial inclusion to users who lack conventional credit profiles. As a result, DeFi lending becomes more efficient, accessible, and safer for all participants. Moreover, AI enhances liquidity mining strategies by predicting optimal times to provide liquidity or withdraw it based on market trends and protocol incentives. These predictions help liquidity providers maximize their returns while minimizing risks related to impermanent loss or sudden market shifts. AI-powered dashboards offer real-time analytics and actionable insights, empowering users to make informed decisions about their liquidity positions. This intelligence not only benefits individual investors but also supports the overall health and stability of DeFi ecosystems. In the area of decentralized insurance, AI is transforming how claims are processed and risks are evaluated. Traditional insurance models can be slow and opaque, but decentralized insurance protocols use AI to automate claims verification by analyzing blockchain data and external inputs. Machine learning models can detect fraudulent claims, assess damages, and trigger payouts swiftly, improving user trust and operational efficiency. This automation reduces administrative costs and accelerates claim settlements, making insurance more accessible and affordable within decentralized finance. AI's role in cross-border payments within the crypto ecosystem is equally significant. Cryptocurrency facilitates near-instant, low-cost international transfers, but challenges like exchange rate volatility and regulatory compliance remain. AI-powered platforms manage these issues by optimizing currency conversions, monitoring compliance with anti-money laundering regulations, and detecting suspicious activities across jurisdictions. This integration enhances the reliability and scalability of global crypto payments, fostering broader adoption by businesses and consumers worldwide. The application of AI in decentralized identity management is another emerging trend linked to DeFi. Self-sovereign identity systems enable users to control their personal data without relying on centralized authorities. AI enhances these systems by securely verifying identities through biometric data, behavioral patterns, and other signals while maintaining privacy. Reliable identity verification is crucial for enabling compliant financial services in DeFi, such as lending, trading, and insurance. By combining AI with blockchain, decentralized identity solutions aim to create a safer and more user-centric financial environment. Furthermore, AI can help mitigate systemic risks in interconnected DeFi protocols. The complex web of smart contracts and cross-protocol dependencies creates vulnerabilities to cascading failures or exploits. AI models simulate various risk scenarios and stress tests, identifying weak points and recommending preventive measures. Early detection of potential systemic issues allows developers and users to act proactively, reducing the likelihood of widespread disruptions. This risk management capability is vital for ensuring the long-term resilience of decentralized finance networks. AI also aids in optimizing tokenomics design for new projects launching on blockchain platforms. Tokenomics, the study of token supply, distribution, and incentives, is critical to a project's success. AI analyzes market dynamics, user behavior, and competitive landscapes to recommend token structures that balance user incentives with sustainability. Effective tokenomics design attracts investors, fosters community engagement, and supports healthy network growth. This strategic use of AI helps crypto projects launch with stronger foundations and better chances of success. In addition, AI-driven analytics platforms provide valuable market intelligence to crypto investors and traders. These platforms aggregate data from multiple exchanges, social media, news outlets, and on-chain activity to deliver comprehensive market overviews. Advanced visualizations and predictive models allow users to track trends, identify emerging opportunities, and avoid risks. As the crypto market matures, these AI-powered insights become indispensable tools for navigating its complexities. Lastly, AI is instrumental in bridging traditional finance with the decentralized crypto world. Hybrid platforms leverage AI to offer seamless fiat to crypto gateways, compliance solutions, and integrated asset management services. These solutions facilitate the onboarding of institutional investors and mainstream users, helping to close the gap between conventional financial systems and blockchain-based innovations. By enabling smoother integration, AI accelerates the adoption of decentralized finance on a global scale. 8. Central banks and AI. Policy-making in the digital age. Central banks around the world are increasingly turning to artificial intelligence to modernize their approach to monetary policy and economic management. Traditionally, central banks relied on historical data and periodic reports to guide decisions on interest rates, inflation control, and financial stability. However, the digital age demands faster, more adaptive strategies. AI enables central banks to process vast volumes of real-time data, from consumer spending and employment statistics to global market trends and geopolitical events, allowing them to react more swiftly and accurately to changing economic conditions. This real-time data integration empowers policymakers to update inflation models and monetary frameworks dynamically, reducing lag time and enhancing policy effectiveness. Machine learning algorithms play a crucial role in forecasting inflation and economic growth by analyzing complex patterns that are difficult for human analysts to detect. These models incorporate non-traditional data sources such as social media sentiment, satellite imagery, and online transaction flows, which provide early indicators of economic shifts. By leveraging such diverse datasets, AI-powered tools help central banks anticipate inflationary pressures or economic downturns before conventional indicators become evident. This proactive stance helps in crafting timely interventions, which is critical in preventing financial crises and maintaining economic stability. Furthermore, AI aids in simulating the impact of various policy decisions through advanced economic modeling. Central banks can use AI-driven simulations to test different scenarios, such as changes in interest rates, quantitative easing measures, or regulatory adjustments, and predict their outcomes on inflation, employment, and GDP growth. These simulations allow policymakers to evaluate the potential risks and benefits of each option more comprehensively, improving decision-making quality. The ability to run multiple complex scenarios quickly ensures that central banks are better prepared to handle unexpected economic shocks. AI also enhances the transparency and communication strategies of central banks. Clear communication is vital for managing market expectations and ensuring the effectiveness of monetary policy. By using AI to analyze market reactions, news sentiment, and public opinion, central banks can tailor their messaging to different audiences. Natural language processing (NLP) tools assist in drafting reports, speeches, and press releases that are more precise and accessible, reducing misinterpretations that could destabilize markets. This improved communication fosters trust and confidence among investors, businesses, and consumers. The integration of AI in central banking extends to risk management and financial oversight. Central banks monitor the banking sector and financial institutions to safeguard systemic stability. AI systems analyze transaction data, credit exposures, and market conditions to identify emerging risks such as asset bubbles, liquidity shortages, or cyber threats. Early detection enables regulators to implement preventive measures or corrective actions, thus reducing the likelihood of financial disruptions. This data-driven approach to supervision strengthens the resilience of the financial system as a whole. Moreover, AI supports central banks in combating financial crimes and ensuring regulatory compliance. Machine learning algorithms are employed to detect money laundering, fraud, and terrorist financing activities within the banking and financial networks. By analyzing transaction patterns and customer behaviors, AI can flag suspicious activities in real time, facilitating faster investigations and enforcement actions. This technological edge enhances the integrity of the financial ecosystem and protects it from illicit activities that could undermine economic stability. Central banks are also exploring the use of AI in managing and issuing digital currencies, such as central bank digital currencies, CBDCs. The introduction of CBDCs requires sophisticated technology to handle issuance, circulation, and security. AI can optimize transaction verification, monitor usage patterns, and prevent fraud or misuse in digital currency ecosystems. These capabilities are essential for ensuring that CBDCs operate efficiently and securely, enabling central banks to modernize payment systems and promote financial inclusion. Additionally, AI enables better coordination between central banks and other regulatory agencies. Economic policies often require collaboration across borders, especially in a globally interconnected financial environment. AI-powered platforms facilitate data sharing, joint analysis, and synchronized policy responses among institutions. This cooperation helps address cross-border financial risks and supports the stability of the international monetary system. Enhanced coordination also helps central banks align their policies with broader economic goals such as sustainable growth and inflation targeting. The adoption of AI in central banking also raises important ethical and governance considerations. Policymakers must ensure that AI models are transparent, unbiased, and accountable. Decisions based on AI outputs should be explainable to stakeholders to maintain trust and legitimacy. Central banks are investing in developing frameworks that govern AI use, ensuring compliance with data privacy regulations and mitigating risks associated with automation. Responsible AI deployment is essential to maximize benefits while minimizing potential negative impacts on society. In summary, AI is transforming how central banks formulate and implement monetary policies in the digital age. By enabling real-time data analysis, advanced forecasting, risk management, and enhanced communication, AI empowers central banks to be more responsive and effective in maintaining economic stability. As these technologies evolve, they will play an increasingly central role in shaping the future of global finance and economic governance. AI's role in enhancing central banks' crisis response capabilities is becoming increasingly vital. During sudden economic shocks, such as the COVID-19 pandemic or geopolitical conflicts, the speed and accuracy of policy interventions can determine the difference between stabilization and prolonged recession. AI-driven analytics allow central banks to monitor evolving economic indicators minute by minute, assess the immediate impacts on various sectors, and design targeted relief measures accordingly. This agility reduces the risk of blanket policies that may unintentionally harm vulnerable groups or sectors, making interventions more efficient and equitable. Furthermore, AI supports the modernization of payment infrastructures managed by central banks. As digital payments rise globally, central banks need to ensure secure, fast, and reliable transaction systems. AI algorithms optimize transaction routing, detect anomalies, and prevent fraud in real time, improving the safety and efficiency of national payment networks. Enhanced payment systems also facilitate financial inclusion by enabling broader access to digital financial services, especially in underserved or remote communities. Through AI, central banks can promote economic participation on a wider scale. Another significant application of AI for central banks lies in macroprudential policy design. These policies aim to mitigate systemic risks and maintain overall financial stability. AI models analyze interconnected financial data, such as bank exposures, market liquidity, and credit cycles, to identify vulnerabilities that traditional models might overlook. By forecasting potential crises and stress points in the financial system, AI helps central banks implement preemptive measures, such as adjusting capital requirements or tightening lending standards. This proactive approach strengthens the resilience of the economy against shocks. AI also enhances the integration of environmental, social, and governance (ESG) factors into central banking policies. With increasing emphasis on sustainable finance, central banks use AI to analyze climate-related financial risks and assess the impact of environmental policies on the economy. Machine learning models evaluate how climate change affects asset valuations, credit risks, and investment flows. This data-driven insight enables central banks to align monetary policies with sustainability goals, supporting a transition to a greener economy while safeguarding financial stability. Moreover, AI facilitates the development of personalized economic forecasts tailored to regional or sectoral specifics. Instead of relying solely on national-level aggregates, AI can dissect economic data at finer granularities, providing insights into how policies affect different regions, industries, or demographics. This nuanced understanding helps central banks design more targeted interventions, addressing localized economic challenges and promoting balanced growth across the country. Personalized forecasting also improves the inclusivity of monetary policy. The use of AI-driven natural language processing tools enables central banks to monitor and analyze vast amounts of textual data, such as news reports, research papers, and social media trends. This capability offers an additional layer of economic insight by capturing public sentiment, policy debates, and emerging risks in real time. By incorporating this qualitative data alongside traditional quantitative metrics, central banks can form a more comprehensive view of the economic landscape. This holistic analysis supports more informed and effective policy decisions. Central banks are also exploring partnerships with fintech companies and research institutions to leverage AI innovation. Collaborations facilitate access to cutting-edge AI technologies, datasets, and expertise that may be beyond the scope of traditional central bank operations. These partnerships accelerate the adoption of AI-driven tools and foster a culture of innovation within central banks. As a result, central banks become more agile and adaptive, better equipped to navigate the rapidly evolving financial ecosystem. Lastly, AI empowers central banks to improve financial literacy and public engagement through interactive platforms and personalized communication. AI chatbots and virtual assistants can explain complex monetary policies in simple language, answer public queries, and provide updates on economic conditions. This direct engagement enhances transparency and builds public trust in central bank actions. Educated and informed citizens are more likely to support policy measures, contributing to smoother implementation and economic stability. 9. Ethical concerns and financial bias in AI systems. Artificial intelligence is transforming finance with unprecedented speed and scale, but it also raises significant ethical concerns that cannot be ignored. One of the primary issues is the risk of bias embedded within AI financial models. These models learn from historical data, which often reflects existing social and economic inequalities. If unchecked, AI can perpetuate or even amplify these biases, leading to unfair treatment of certain groups in areas such as credit scoring, loan approvals, and investment recommendations. This systemic bias can reinforce barriers for marginalized communities, undermining the principles of fairness and equal opportunity in financial services. Data privacy is another critical ethical challenge in AI-driven finance. Financial institutions collect vast amounts of sensitive personal and transactional data to train AI models and deliver personalized services. However, improper handling or breaches of this data can lead to severe privacy violations and loss of customer trust. There are growing concerns about how data is collected, stored, shared, and used, especially when consumers may not be fully aware of the extent of data processing involved. Striking the right balance between leveraging data for innovation and protecting individual privacy rights remains a key regulatory and ethical dilemma. The regulatory landscape for AI in finance is still evolving, creating uncertainty about compliance and accountability. Financial regulators worldwide are working to develop frameworks that address the unique risks posed by AI, including bias mitigation, transparency, and model explainability. However, regulatory gaps persist, particularly regarding cross-border data flows and the use of AI algorithms in automated decision-making. Without clear and enforceable standards, there is a risk that AI systems may operate with insufficient oversight, potentially harming consumers and destabilizing markets. Transparency in AI models is crucial for ethical financial practices, but it remains a significant challenge. Many AI systems operate as black boxes, where the internal decision-making processes are opaque even to their developers. This lack of explainability makes it difficult for financial institutions, regulators, and customers to understand how specific outcomes are reached. The inability to explain AI-driven decisions raises questions about accountability and trust, especially when those decisions impact individuals' financial well-being. Efforts to develop interpretable AI models and audit mechanisms are ongoing but require further advancement. Bias in AI can stem from multiple sources, including the choice of training data, model design, and implementation. For instance, if historical lending data reflects discriminatory practices, an AI system trained on this data may deny loans unfairly to certain ethnic or socio-economic groups. Similarly, gender or geographic biases can arise if the training datasets lack diversity. Financial institutions must actively identify and correct such biases through rigorous testing, diverse data sourcing, and inclusive algorithm design. Ethical AI deployment necessitates ongoing monitoring to detect and mitigate bias throughout the model lifecycle. Another ethical concern involves the impact of AI automation on employment within the financial sector. As AI systems take over tasks such as customer service, credit assessment, and fraud detection, there is a risk of job displacement for many workers. While automation can improve efficiency and reduce costs, it also raises social responsibility questions about workforce reskilling, job creation, and economic inclusion. Financial institutions and policymakers must collaborate to ensure that AI adoption does not exacerbate inequality or leave large groups behind. AI-driven financial decisions can also have unintended consequences when algorithms optimize purely for profit or efficiency. For example, high-frequency trading bots designed to maximize returns may contribute to market volatility or flash crashes. Similarly, automated lending models focused on risk minimization might exclude high-potential but non-traditional borrowers. Ethical AI development in finance requires a holistic approach that balances profitability with social and economic impact, ensuring AI serves the broader public interest and promotes sustainable financial ecosystems. Data governance plays a critical role in addressing ethical issues related to AI in finance. Establishing robust protocols for data collection, usage, storage, and sharing is essential to safeguard privacy and maintain data integrity. Financial institutions must implement strict controls to prevent unauthorized access and misuse of data, as well as comply with relevant data protection laws such as GDPR and CCPA. Transparent data governance frameworks also support auditability and regulatory compliance, fostering trust among stakeholders. The ethical deployment of AI in finance demands collaboration among technologists, regulators, ethicists, and industry leaders. Stakeholder engagement is necessary to develop guidelines and best practices that align AI innovation with societal values. Regular impact assessments and ethical audits should be mandated to evaluate AI systems continuously. Furthermore, financial literacy programs must educate consumers about AI's benefits and risks, empowering them to make informed decisions and advocate for their rights. In conclusion, while AI offers transformative potential for the financial sector, addressing ethical concerns is paramount to ensure its responsible use. Financial bias, data privacy, transparency, and regulatory challenges pose significant risks that require proactive management. By embedding ethical principles into AI design and governance, the finance industry can build more equitable, trustworthy, and sustainable AI-driven systems that benefit all stakeholders. Another pressing concern in the ethical use of AI in finance is the potential for algorithmic redlining, where certain communities or individuals are systematically excluded from financial services based on flawed or biased data interpretations. For example, zip code-based data might be used to infer creditworthiness, unintentionally reinforcing racial or socio-economic discrimination. These invisible walls can limit access to essential financial resources such as loans, insurance, or investment advice. The worst part is that such decisions often go unquestioned because they are automated, buried deep within lines of code that are not easily scrutinized by either customers or regulators. Unless specifically audited, these biases remain unchecked. A growing debate also surrounds the ethical implications of AI-driven surveillance and behavioral monitoring in finance. AI systems now track consumer spending patterns, online activity, social behavior, and even psychological traits to build financial profiles. While this can lead to better personalization, it also walks a fine line between service enhancement and invasive surveillance. Many consumers are unaware of how much behavioral data is being collected, or how it is being analyzed to influence decisions like loan approvals or credit card limits. This asymmetry in knowledge creates a power imbalance between financial institutions and their clients, where the latter often have no recourse or transparency. Financial AI systems also pose ethical risks in international contexts, where uneven regulation and infrastructure can lead to exploitative outcomes. In developing economies, for instance, AI is increasingly used in microfinance and mobile lending, but the models may be imported from or designed for very different economic conditions. This misalignment can lead to predatory lending practices, unmanageable debt cycles, or the denial of services to those who need them most. Moreover, the lack of local data or financial history in such regions makes it challenging to create fair and effective AI models. Ethical AI in global finance must be adaptable, context-aware, and sensitive to regional realities. The commodification of user data in the AI age is another ethical quagmire. Financial companies and fintech platforms often sell anonymized consumer data to third parties for marketing or research purposes. However, anonymization techniques are not always foolproof, and there have been cases where individuals were re-identified using cross-referenced datasets. Even when identity is protected, the use of consumer data without explicit, informed consent raises significant ethical red flags. Regulators and ethics boards must establish stronger guidelines on data ownership, transparency, and consent to prevent misuse and ensure consumer autonomy. The psychological impact of AI decisions in finance also demands attention. When individuals are denied a loan, charged higher interest, or flagged as a risk, based purely on machine-made predictions, it can affect their financial confidence and emotional well-being. Worse, the lack of a human intermediary often means there is no clear explanation or room for negotiation. This sense of helplessness or frustration can erode trust in financial institutions and create a perception of cold, dehumanized systems. Ethical finance must retain space for empathy, human judgment, and appeals, especially in life-impacting financial decisions. Ethical AI in finance also requires diversity in teams designing these systems. A lack of diversity among developers, data scientists, and decision-makers increases the risk of unconscious bias being embedded in financial algorithms. If the creators of these systems do not represent the full spectrum of society, their assumptions and blind spots will likely be reflected in the tools they build. Companies must invest in inclusive hiring, bias awareness training, and interdisciplinary teams to ensure a broader ethical lens is applied throughout the AI development process. This cultural and structural commitment is essential to avoid replicating historical injustices through code. Consumer rights advocacy is another key dimension in the ethical use of AI in finance. As AI becomes more dominant in decision-making, there is a need for robust mechanisms through which consumers can challenge, review, or appeal AI-based decisions. Right now, many systems offer little to no feedback loops, leaving users powerless against unfair or incorrect judgments. Financial institutions should implement accessible channels for redress and create clear documentation that explains how AI-based outcomes are determined. Additionally, regulators should mandate explainability clauses for any automated financial decision-making system. The financial sector must also grapple with the long-term consequences of over-automation. As more institutions adopt AI to cut costs and increase efficiency, there is a risk of reducing the quality and depth of human relationships in finance. Personalized financial advice, ethical discretion, and emotional intelligence are all qualities that machines currently lack. While AI can handle large volumes of transactions and data analysis, it cannot replace human empathy or understanding in complex, emotionally charged financial situations. Therefore, AI should be viewed as a complement, not a replacement, to ethical human judgment in finance. Lastly, financial institutions must adopt ethical AI frameworks and commit to regular audits, transparency reports, and independent oversight. Ethics should not be an afterthought or a compliance checkbox, but a core design principle integrated at every stage of AI development and deployment. Institutions must disclose how their models are built, what data they rely on, how often they are updated, and how they are governed. Ethical finance in the age of AI requires a shift in mindset, from competitive secrecy to collaborative accountability, where all players work together to build systems that are just, fair, and inclusive. Artificial intelligence is not just a supporting tool in finance anymore, it is fast becoming the structural core. As machine learning systems become smarter, more autonomous, and deeply embedded into financial infrastructure, a future where AI is the primary decision-maker in global finance seems not just possible, but likely. From instantaneous credit assessments to fully autonomous hedge funds, the pace at which AI is evolving hints that traditional financial models will soon become relics. What we are witnessing is a digital renaissance, a re-architecture of financial logic where human intuition is being replaced with computational precision. In the next decade, we can expect AI to take over much of the financial plumbing that currently requires human oversight. Real-time asset valuation, dynamic risk pricing, automated regulatory compliance, and cross-border transaction facilitation will become default AI functions. Systems will not just execute tasks, they will constantly learn from trillions of micro-interactions in the financial ecosystem, making them more adaptive and resilient than any current structure. This would allow institutions to scale operations, reduce costs, and deliver services at an unprecedented speed and accuracy. Financial institutions of the future will likely resemble tech companies more than traditional banks. Data centers, algorithms, and AI models will replace many of the current layers of bureaucracy. Investment portfolios may be constructed, monitored, and modified in real time by AI agents based on shifting market dynamics and personal preferences. Loans and mortgages will be approved in seconds by bots analyzing behavioral patterns, social signals, and geo-economic indicators, offering ultra-tailored options to clients. Financial advisors might no longer be humans but intelligent, emotionally aware AI interfaces. Financial institutions should implement accessible channels for redress and create clear documentation that explains how AI-based outcomes are determined. Additionally, regulators should mandate explainability clauses for any automated financial decision-making system. The financial sector must also grapple with the long-term consequences of over-automation. As more institutions adopt AI to cut costs and increase efficiency, there is a risk of reducing the quality and depth of human relationships in finance. Personalized financial advice, ethical discretion, and emotional intelligence are all qualities that machines currently lack. While AI can handle large volumes of transactions and data analysis, it cannot replace human empathy or understanding in complex, emotionally charged financial situations. Therefore, AI should be viewed as a complement, not a replacement, to ethical human judgment in finance. Lastly, financial institutions must adopt ethical AI frameworks and commit to regular audits, transparency reports, and independent oversight. Ethics should not be an afterthought or a compliance checkbox, but a core design principle integrated at every stage of AI development and deployment. Institutions must disclose how their models are built, what data they rely on, how often they are updated, and how they are governed. Ethical finance in the age of AI requires a shift in mindset, from competitive secrecy to collaborative accountability, where all players work together to build systems that are just, fair, and inclusive. Artificial intelligence is not just a supporting tool in finance anymore, it is fast becoming the structural core. As machine learning systems become smarter, more autonomous, and deeply embedded into financial infrastructure, a future where AI is the primary decision-maker in global finance seems not just possible, but likely. From instantaneous credit assessments to fully autonomous hedge funds, the pace at which AI is evolving hints that traditional financial models will soon become relics. What we are witnessing is a digital renaissance, a re-architecture of financial logic where human intuition is being replaced with computational precision. In the next decade, we can expect AI to take over much of the financial plumbing that currently requires human oversight. Real-time asset valuation, dynamic risk pricing, automated regulatory compliance, and cross-border transaction facilitation will become default AI functions. Systems will not just execute tasks, they will constantly learn from trillions of micro-interactions in the financial ecosystem, making them more adaptive and resilient than any current structure. This would allow institutions to scale operations, reduce costs, and deliver services at an unprecedented speed and accuracy. Financial institutions of the future will likely resemble tech companies more than traditional banks. Data centers, algorithms, and AI models will replace many of the current layers of bureaucracy. Investment portfolios may be constructed, monitored, and modified in real time by AI agents based on shifting market dynamics and personal preferences. Loans and mortgages will be approved in seconds by bots analyzing behavioral patterns, social signals, and geo-economic indicators, offering ultra-tailored options to clients. Financial advisors might no longer be humans but intelligent, emotionally aware AI interfaces.